So today we're going to talk about how to time the real estate market. You're thinking, what? Time the real estate market? Yeah, that's exactly what I'm thinking. Like many things, including life, real estate market has cycles or seasons to it, okay? And in life we have seasons. We've got spring, summer, fall, winter, okay? And the real estate market has cycles just like that. And they're driven by a lot of different factors, which to a lot of people can seem random, but they're really not random. They're highly predictable and they have rules. Now today we're going to break down the market cycles and learn how to identify where we are in a particular cycle and how to time the market for the best returns if you're in the multifamily space like we are. The graph that we're going to use today is called the Mueller Graph, and this graph was made popular by the University of Denver, where you know I spent a lot of time, by a guy named Glenn Mueller. He was a professor there, and he's been posting graphs like this for over 30 years, and I think their information is really top shelf stuff. Now the great part about this graph is that it can cover multiple decades if you like, or just 1 year. And even better than that is that different markets can be in different places on this graph, and making some areas better for investment than others depending on where they are in the cycle. Now today we're going to focus on 2008 through today, through 2024 for our time frame. Now, the first part of a market cycle is recovery, okay? Right here. And for reference, that's what happened between 2011 and 2016. Now, after the crash in 2008, and trust me, I remember that crash. Okay, I don't know if you know my story, but I got my ass handed to me in 2008. And then the early part of the 2010s, we saw, rent declines, home price declines, and lower occupancies across the market. After a couple years, the fear started to go away, and we saw occupancy start to tick back up and rent growth coming back up, and lots of real estate investors jumping into the market for the first time to take advantage of those low prices. Now, I'll bet you anything that 90% of my competitors, the gurus out there, started in real estate around this time due to the low prices. Made it look like you can't lose. The second part of the market cycle is expansion, okay? And that's where we are here, in the expansion phase. And for reference, this is what happened between 2016 and 2022. Rents continued to go up, builders started refilling their pipelines, and the market started to pick up again. As time went on, the lower supply that was created when people were actually still recovering from the crash started to show up. And the U.S. saw it needed a lot more housing. And then, kind of in a unique situation, we had COVID-19 happen, right? And jumpstart millions of people wanting to buy homes. And of course, the interest rates were very low then. And at that time, multifamily investors started snapping up properties as, the high rent growth made it really turned into a cash grab. Okay, and for example, this is what Mueller's analysis showed for the multifamily market in 2022. You'll see that some of the markets were in later stages of expansion, while several prominent metros were already in hyper supply. Okay, like Tampa here, that's the MSA that I live in, the Metropolitan Statistical Area. I mean, we were already in hyper supply. We saw 34% rent growth 1 year here. So, different cities can be in different phases here, as you can see. Here we've got, a bunch of cities in expansion mode, like I just talked about, including cities in Florida, other cities like Orlando. But then you've got cities like Tampa that were already in hyper supply. So, very interesting. The third part of the market cycle is hyper supply, like I just said, right? And that's where we are here. For reference, this is what happened between 2022 and 2023 for most of the country. You'll notice how much faster this line goes down than it goes up, right? This goes to show you that when the market turns, it can turn very, very quickly. And it did. And as rent growth was through the roof, new construction was delivering thousands of units, and our good friend Powell at the Fed decided it was time to turn down the heat in the economy, and all of a sudden the market became saturated with too many units, and too many units that were asking too much rent. And rent growth started declining as inflation was peaking. And then bridge debt came into the picture and became, I was actually in the picture, I'm sorry, and became less attractive at that point. The get it while it's hot mentality of real estate really started changing. And I will tell you, bridge debt is going to cause a lot of problems in our industry. It's already causing a lot of problems because it's adjustable rate debt, it's short-term debt, and a lot of operators are in trouble that have bridge debt. I've got a couple of assets myself that I'm having to deal with. It's a pain in the butt. Then there's recession. And that's the fourth part of the market cycle. And for reference, this is what's happening right now between 23 and 24, probably will be happening into 25 as well. Rent growth in most of the major markets has bottomed out and zero. In some cases, it's actually negative rent growth, and prices have seen, major pullback. Sellers are losing properties due to that bridge debt, just like I talked about. We're seeing foreclosures. I hate it, but we are already. And I'm finding deals. We've got a phenomenal deal under contract right now. We're seeing deals already. But, they're losing properties because of the bridge debt, because of mismanagement, and without rent growth to save them. There's a lot of fear in the market. The catchphrase at the National Multifamily Housing Conference, NMHC in San Diego, was survive till 25. I think it's going to be survive till 26, because I think 25 is going to be tough too. But again, with crisis comes opportunity. We're seeing tons of opportunity right now. Now, many investors, are scared of losing like they did in 2008. And to be honest, I've had some of those thoughts myself. It's natural to have a bit of fear. Fear can be healthy. Where successful investors emerge is recognizing that is past that fear. There's always opportunity. With crisis comes opportunity. And so we're gearing up right now for it. Now, if you're able to find a property that's being sold for a sizable discount, and you can underwrite that property without relying on high rent growth, in your pro forma, and you're in a market that's holding steady or at least not getting pounded right now, then you can get a great deal like those investors did when they started picking up pieces in 2008. Like I say, we've got an asset in San Antonio right now, screaming deal. We're buying it for $100,000 a unit. The one next door sold for $137,000 a unit. It's almost a 40% discount. I'm going to tell you, I don't think we've seen the worst of it yet. We're going to continue to have a lot of fear in the market through 2024 and probably 2025. Then the cycle will begin again. And that, my friends, is why I want to be buying property right now, because by buying now in 24 and 25, I'll be at the end of my renovations and hold period around 29 and 30, right? Meaning I'll be well positioned to sell when the market's heating up again, and all my investors are going to see some big returns. Okay, so now let's talk about major cycle change indicators. How can you know what the real estate market looks like, what each part of the cycle means, right? And where we are in the cycle right now. The next thing you've got to know is when the market's shifting, right? And there's certain statistics that we can look at to know when the market's moving to a new phase. So the first is job growth and rent growth. In phase one, expect job growth and rent growth to be relatively flat and to positive. Now, using resources like the U.S. Bureau of Labor Statistics and CoStar, those are both resources we use, you can track how these stats start from a negative trend and shift to becoming positive, right? And with an upward trajectory and entering the realm of 2 to 4% annual rent growth and 3 to 7% annual job growth, for example. As the market moves to expand, rent growth can easily exceed 5% in top markets, with job growth moving towards 10% year-over-year growth as well. But you want to be, fairly conservative right now. We will be turning soon, though. Job growth and rent growth again. However, during phase 3 and 4, you'll typically see rent growth start to crater back to 1% or 0% before moving negative. And we're seeing negative from places like Austin, Texas. Now, usually it also comes with job market pullback, which makes this recession kind of uncommon because the job market keeps growing. Now, if you ask me, I'm not too sure about those numbers, though, and I don't put a lot of salt in great job growth numbers when the rest of the market isn't doing too hot. I think the wool could be being pulled over our eyes in some fashion with job growth numbers, personally. Now, the next thing we look at is interest rates. When the market is recovering, the Fed will definitely drop rates to stimulate economic growth, just like they did, after the 2008 crash. Now, from the St. Louis Fed, interest rates tumbled in 2008 and only started coming back up around 2016, 8 years later. Then during COVID, they got cut briefly again, right there, okay, before they skyrocketed back up, as you can see here. Now, just like before, you can see the recovery happened from 2010 and 11 all the way to 2016, and then expansion from 2016 to 2022, and then the Fed overreacted and dropped rates way too quickly, and hyper supply in 23 and 24, leading us to where we are right now. Crazy times where we are right now. Using data like job growth and rent growth and interest, rates you can very accurately identify, and help to determine where we are in market cycles and time your acquisitions and position yourself to make a lot of money buying right. And that's how the real fortunes are made in real estate. And you can be sure I'll be right there with my team buying properties right now. That's where we are. So I appreciate you watching this today. I hope it adds a little bit of value. See you soon.